On Friday, we had presented the covered combinations. What is it, when to use it, pros and cons of the strategy for Anthony. He had asked us about just an introduction to the covered call strategy. We did a basic introduction, discussed the structure of buying stock, selling an out-of-the-money call, and at the same time selling an out-of-the-money cash secured or naked put on the same security. We discussed why and how investors use it and the pros and cons of the approach. At the end of that discussion, Fernando had asked, is it possible to test on the Trade Simulator tool this structure, looking at covered combinations just to see if the expectancy play in our side. This tool, of course, is available at radioactivetrading.com under the Resources tab. It allows you to put in your expected profit for a trade, the expected loss you take on average, your win-loss ratio, and it runs a scenario through 100 trades to see what your expectancy or outcome of potential profit would be in a simulation. Now, I didn't answer that question directly when Fernando asked because, honestly, I didn't have all the right numbers, and I didn't want to go through an exercise without the proper numbers. So to get the numbers, we used the backtesting tools on PowerOptions, the Smart History Excel tool. We went into covered combinations, and we ran a basic 12-month test from August 2020 to expiration on August 2021. We used the default criteria that were created by Ernie Renner and the PowerOptions staff for the covered combination strategy. We tracked the positions just to expiration, going 1 month out for each cycle, doing no management, rolling, or taking stock assignment on the short put side. We tabulated the averages for each month going forward. Now, how does this tool work in a nutshell? Well, we simply put in the date that we'd like to run a screen based on the criteria, either the PowerOptions default criteria or one of your saved searches. We see the trades that match the selected criteria on the selected date at close of business. We can then calculate the group results to see how each of the top 15 trades that matched our criteria performed to the end of expiration. Well, for the first run, how did the top 15 perform? Well, we see the outcome of each individual trade at expiration, remember no management, and then we get a summary. And in this case, from August 24th, to September 18th of 2020, only 7 out of 15 were profitable. Doesn't mean they received the full profit. If they were between the short call strike and the short put strike or above the break even, there still would have been some small profit. Only 47% were successful, and the average return on all 15 trades was a loss of 0.7%. Of course, you can also see the QQQ performance at minus 6.3% over that same time period, and the S&P 500 return down 3.4% over that same time period. Using the more information buttons, once I get the results from my historical search, I can also analyze each position individually to see if it ever hit a 10 or 15% loss where I might have considered closing the position. You can link to the historical option chain to see the various prices of other legs, or if you were looking to roll, you could do that manually. And you can even go into the price history for that individual call and individual put and the change with the individual stock each day over that time period from when you ran your search to expiration. But we did this manually. We went month by month, tabulating the summary and tabulating the average return on winners and the average return on losses for each individual month to get the baseline that Fernando wanted to run the simulation. So, as we can see here, those first results we tabulated from August 24th, 2020 to September 18th using the default covered combination settings. We only had a 47% win rate out of the 15 trades. The average return if all 15 were opened was a loss of 0.7%. Now, the average return on the winning trades, those 7 out of 15 winners, was 6.5%, but the average loss on the losers in this first month's run was a loss of 7.1%. That doesn't look like it's going to be a successful track record. Now, I hint here that the VIX was at 2237. not that high, but much higher than we are right now in sort of that $15, $16, $17 range, and it fluctuated throughout that year of 2020 to 2021. Now, we did all this because we need a good measurement of expectations in order to answer Fernando's questions. We're going to take the inputs of the summary of those 12 months, and we'll use that to the Trade Simulator tool at Radioactive Trading to input our target return, the average return on winners, the average loss on the losers for that whole 12-month period, probability of success or probability of loss, and then we'll use the starting capital and the amount of that capital allocated to each individual trade. This will allow us to run a simulation, flip a coin 100 times. Heads, we make the average target return. Tails, we lose the average loss on the losers, and it's going to run through that win ratio through 100 trades to see what we might end up with as a simulation at the end of 100 trades. Now, you may be asking, what are the default settings that were used for this covered combination? The initial value search for covered combinations and power options is using a combination of stock criteria, of course, and option criteria as well. To look for good neutral to bullish stocks, we're looking for stocks with a good broker recommendation, either a buy or strong buy recommendation, looking for stocks trading above their 50-day moving average. Since this is a capital intensive strategy, we have to buy the stock and sell the call and put up the capital to sell that out of the money put, just like you would a cash secured put. We limited the stock prices between $5 and $150. We're looking for a relative PE ratio of 0 to 90, and we, of course, are avoiding earnings between now and expiration because we don't want any sudden surprises that could cause us to lose to the downside with a poor earnings announcement. We're just going out to the next standard expiration, the option expiration time frame. We're looking for a minimum 3% return if assigned, if the stock moves up and we're assigned on that higher call strike price. We want a downside protection. The total option premium collected for the call option and the put option divided by the stock price of 3%. So in other words, the stock can fall 3% before we technically start losing money on the position. We don't want to go too far out of the money on the call. There's no point in going 5 strikes out of the money and only getting 10 cents. So we're just going 1 strike out of the money on the call and essentially 1 or 2 strikes out of the money on the put. We want the put to be at least 4% out of the money to have some room for the stock to fluctuate before we potentially get assigned. And we put in some limitations for the call and put bid-ask spread and some volume requirements as well. The results are sorted by the highest percentage unchanged, meaning if the stock did happen to stay at the same price, we'd be looking at the highest percent unchanged results at the top of our search so that we could evaluate positions that gave us a good return if there was a dull market or a very neutral market. Remember, this is a neutral to bullish strategy. We do want the stocks to go up to get near to that max return on the call side, if that is our goal, and that was explained in the other webinar. The 12-month record for the default initial value screen. Well, we already saw August 2020, success rate of 47%, average return. If we had entered all 15 trades, we would have seen a loss of 0.7%. But the average return on winners was 6.5%. Average loss on the losers was 7.1%. Moving forward, in September, we get a much better success rate, 13 out of 15 successful trades. Total average return was 6.7%. The average return on winners was 7.5%. The average loss on the losers was 3.9%. Don't do as good in October, but still a good success rate, 73%, 11 out of 15. But the average return is only 1.3%. That's because the percent return on winners average was 4.4%, and the average loss on the losers was minus 7.3%. November 2020, 15 total trades at the top. 15 were successful for an average return of 4.3%. The percent return on winners would be 4.3% as well, and there were no losers. That's great. December 2020, 12 out of 15, 80% success rate, average return of 3.1%, average winners 4.4%, average loss on the losers minus 5.9%. And we go down the line, we see an 87% success rate with an average return of 4.8%, February 2021, a 73% success rate with an average return of 2.6%. Now in March, there was a 67% win ratio, 10 out of 15, and there was a total loss of 3.1%. This was dominated by Discovery Communications. I don't know if you remember this time frame, but this was one of the communications stock that was linked to that trade manager or fund manager from Archegos, where they overextended themselves. Credit Suisse Bank, I believe, had to sell shares or close shares because they were well beyond their margin requirements. In about a 3-day period, DISCA dropped from 74.65 to 37.34. The static loss on the covered combination was minus 45.3%. This would have been a monetary requirement of $138.28 per share. So even if you just did 100 shares, you'd be down close to $6,000 on that one trade. If we took DISCA out of the results, this would have changed the dynamic to 10 out of 14 success rate, or 71%, with the average return of 3.3%. We decided to leave it in just for the comparison. April, 67% success rate, a total loss of 0.9% on the portfolio if all 6 trades were open. May of 2021, a 53% success rate, minus 2.1 loss on the total portfolio. June, 40% success rate, a loss of minus 3.1, with the average loss on the losers, 4.9%. And July of 2021 to August expiration, 75% success rate, average return on the winners of 3.2%, and an average loss on the losers of only 1.9%. Well, what does this all add up to? Well, for that 1-year period, August 2020 to expiration of August 2021, there were 160 total trades. Of those 160, 113 were successful, either to max profit or somewhere just above break even, or 70% of the positions. Losing trades, there were 47 losing trades over that 160 piece, or 30% of the total. The average return on all the winners that we just saw came out to 4.84%, and the average loss on the losers was minus 6.3%. So this kind of looks close to almost what you'd expect in a regular covered call scenario. 65, 70, 75% success rate, making 3 to 4% to the upside potentially in good, highly volatile markets. But when the stocks fall 6, 7, 8%, you're still losing 5, 6, or 7% to the downside. This looks about the same kind of numbers. But the simulation turns out very positive. If we took our target return of 4.8%, the average return on the winners, a loss limit of 6.3%, the average loss on the losers, remember, no management was done, no stop orders were in place, and we have a probability of loss of 30%. We start with $10,000, we allocate 50% of that to each individual trade. We did not use commissions here, but you can choose to use commissions and enter your values on the Trade Simulator tool at Radioactive Trading. Well, one result, 70 wins, 30 losses, starting with $10,000. At the end of expiration in the high value, almost doubled that money to $20,137 after 100 trades, and the low value was down about 3.3% to $9,600. This looks a little bit better than a covered call outcome, and it's mainly because we're also getting double the premium. We're able to get a higher target return even though we're doubling almost the capital required in the covered combination, and we limit the losses to a little bit less because of that extra premium as well. So it's a very positive expectancy. Now, you've heard the rumor KISS, keep it simple, simple, or another version of it. For this exercise, we're going to go with KIF, keep in frame of mind. From August 23rd, 2020 to 8/21/2021, this is what SPY did, the broad market view. We're lower left to upper right with some big hiccups in the middle there of September 2020. Remember that 10% decline we had in the market, a recovery to October, and then sort of a fall again in November leading up to the election and other events. And then we just started this slow melt up, little correction, slow melt up, little correction, and it's been consistently going in that direction. This is perfect market conditions for, with some hiccups, of course, but for covered calls, cash secured, naked puts, covered combinations, bull put credit spreads, bull call debit spreads. This is what we're looking for with those types of strategies. This isn't always going to be the market conditions going forward. And remember, in those first few months, September, October, November, December, volatility, the VIX index was pretty high. We're going to take a look at that a little bit later too. Now, with anything we do on Power Options, many of the webinars you've seen before, we talk about a strategy, we talk about a structure, we talk about our preferred searches on Power Options, and that our default searches are designed to help you as a stepping stone to create your own personal search based on your risk-reward tolerance and what type of stocks and what type of return you'd be looking for in a given strategy. Can enhancements been made? Well, let us start with the simplest change. Any blueprint owners or radioactive traders have seen one of the presentations we've done before, Trust the Search Results. A new one from 2021 is coming out soon. Following the default criteria on Power Options for married puts, the ones that we prefer that are discussed in the blueprint, the search we're using typically always outperforms changing to different company lists. We start with our preferred list here in the list function of any search. And if I change it to just screen against stocks with the same married put criteria in the S&P 500 stocks, S&P 100, the NASDAQ 100, value line stocks, different company lists, our preferred list always outperforms stock performance-wise than making any changes. If we ever see a change, we'll change our default search. But that's not happened the last several times we've done this comparison. So let's do the same thing for covered combinations. We're going to keep the same exact stock and option criteria that we had, but we're going to add in our include stock list that we prefer for the married puts and even some covered call picks of the day strategies as well. Well, the first month difference, we already saw with the default settings that the successful positions was 7 out of 15 or 47%, and the average return on the top 15 positions was a loss of 0.7%. Using those same defaults but changing the stock list, that same first month, August 24th to September 18th, we had a 70% success rate. 7 out of 10 were successful, and the average return was a positive 1.9%. So we didn't improve the average return on winners. With just the default criteria, more volatile stocks, we saw an average return on our winners of 6.5% with an average loss on the losers of minus 7.1%. But adding in that list, we only saw an average return of the winners of 3.85%, and the average return on the losers dropped to minus 5.63%. And again, we go through the 12-month record. And in August, we started off with a 70% success rate and average return of 1.9%. Then September, we only found 5 trades, but all 5 were profitable to an average return of 4.5%. Same thing with October, only 4 trades, but all 4 were profitable with a 4.3% average return. November, a 90% success rate with an average return of 2.6%. December 2020, 100% success rate with 15 total trades for an average return of 3.8%. January, February, March, and April, 4 out of 4, 7 out of 7, 8 out of 8, 2 out of 2, 100% success rate. All were profitable either to the max profit or to above break even, respectively to tune of 3.3% average return in January, 3.95% in February, 3.4% in March, and 4.3% in April. In May, only a 50% success rate, average loss of 0.6%, only 3.8% return on the winners average, and the loss on the losers was minus 5.2%. June, similar to what we saw on the other one, 75% success rate, 1.6% average return, and the percent return on winners was 3.3%. The percent loss on the losers was 3.2%. July to August 2021, only 1 trade came up, and it was profitable to the tune of 2.6%, and there were no losses as well. And what does this add up to? What do we do when we make a change to the search? We're likely going to see a lower number of results, and that's what happened here. We had 76 total trades of the same 1-year time frame, but the number of winning trades was 68, or 89.5%. There were only 8 losing trades, or 10.5% of the total. Average return on the winners was only 3.66%, but the average loss on the losers was down to 3.58%. So this gives us targets for that trade simulation: target return of 3.7%, loss limit of 3.6%, probability of loss, well, let's go to a little higher side. We'll go to 11%. It's somewhere between 10 and 11%. We start off with the same $10,000, 50% of that invested into each trade. And again, to keep it simple, we didn't use the commissions. The simulation, more positive. The lower drawdown, the low value in this particular simulation only went down to 9,820, or a drawdown of 1.8%. And the high value, after 100 trades, we almost quadruple what we originally started with that $10,000 in the position. So one simple change changed the probability of success drastically, but it did also alter the target return, but the outcome, by having the higher success rate, could potentially increase profitability. The side-by-side comparison. On the left are 1-year default covered combo numbers. 160 total trades over the course of that year, August 2020 to August 2021. 70% of those 160 trades were winning trades, and 30% were losing trades. Average return on winners, about 4.84%, and the average loss on the losers was minus 6.3%. Taking our 1-year default and putting in our preferred stock list, total trades pretty much dropped in half. We only had 76 total positions, but we get a much higher win rate. 68 of those 76 were successful, close to 90%. This, of course, means we have a lower loss rate, only about 10 or 11% losers. Now, this did lower the average return on the winners from 4.84 down to 3.66%. But we also lowered the average loss on positions from 6.3% to 3.58. And in fact, here, the average loss on the losers is lower than the average return on the winners, which was opposite with just the default settings themselves. I get a chance to use a Futurama reference, I'm going to do it. KIF, keep in frame of mind. What you're seeing here is sort of a scaled down version of that same SPY chart, August 23rd, 2020 to August 21st, 2021. What you're looking at there in the yellow line is the VIX over that same time period. Now, it's shown as a percentage, not as a raw number. But in that first example, we're seeing average returns on winners of 6% and 7%, not on the total, just the average return on the winners. Well, that's because the VIX was extraordinarily high in September of 2020, October of 2020, November of 2020, leading up to the election and other events. And then it started to fall. Good spike back up in February, high volatility. This helps the covered combination because we're getting enhanced premiums. And we're getting it twice, because we're selling an out-of-the-money call and an out-of-the-money put. But that also leads to more fluctuation in the market with the higher volatility, which can cause good things to the upside, but can also cause bad things to the downside, because we're technically risking twice the amount that we'd risk in just a cash-secured or naked put position or in just a covered call, because we have to cover both. As we saw in this 12-month chart, as you started to get closer to April, May, June, and July, the average return on the winners started to drop down from those 5 or 6% down to 4%, 3%, 1%. There was a 1.9%. And that's because the VIX was declining, so the premiums weren't as inflated as they were 10 to 8 months prior to that. So that is something that you have to keep in mind. With that in mind, the full disclaimer: historical records and backtest results are not a promise of future returns. We've already seen and discussed how the upside returns were getting lower and lower as we went on due to the lowering volatility across the market. Trade simulations using the trade simulator tool at radioactivetrading.com based on historical values are not a guarantee of future performance. It is a simulation of the outcome of 100 trades if you do still indeed get close to your target return, you keep your losses to that target loss, and you keep the same success rate. As market conditions change and volatility changes, there are no guarantees that what we've seen in the past year is going to be a guaranteed performance for the next year. No management rules, stops, or rollouts were applied to either covered combination approach discussed in this quick presentation. The covered combination is a capital-intensive strategy. You have to buy shares of the underlying stock to have that covered call position, and you have to put up the money to cover the cash-secured naked put, or if you're using margin on a naked put of 50%, you still have almost twice the amount of money allocated and at risk in this position as you would with just a covered call or just a naked put. High monetary losses can be realized in down markets. But this just gives everyone, and Fernando, a gauge of what the expectations were over the last year and the performance of our defaults on power options and our defaults on power options with a slight tweak and enhancement and what one might expect in the right market conditions for the covered combination strategy.